to the most important hour in radio. I am your host, investment advisor Sam DeGreen, and this is Freedom Through Finance, broadcasting from the intergalactic headquarters of Arizona's trusted fiduciary, fee-only investment advisor, DeGreen Private Wealth, located at the beautiful Scottsdale Professional Building, you guessed it, in Scottsdale, on Raintree and North 87th Street. You know the rules. Investing involves risk, and we are not affiliated with other radio advisors. Let's get started.
Yep, let's get started indeed. Welcome, everybody. Welcome. I am investment advisor Sam DeGreen, and as always, we are coming to you live from the intergalactic headquarters of DeGreen Private Wealth at the beautiful Scottsdale Professional Center right here in your own backyard, Scottsdale, on Raintree and 87th. So right off the 101, but most importantly, we're right here in your own backyard, and that's what matters. Well, first and foremost, happy Father's Day. For those of you who forgot, Father's Day is coming up. You still have time to overnight your loved one, or to overnight a gift to your loved one, or, maybe just a good card will do. But happy Father's Day, and of course to my dad, attorney and certified financial planner Keith DeGreen, who is out in the People's Republic of California, just enjoying retirement. But it's always you cannot underestimate just the importance of dads. It's something that gets lost pretty easily, especially when you watch your modern sitcoms where the dad is always the dummy, and so on. So it's important for men to have a male influence, and same with women. All right. Either way, that's enough on Father's Day. So, it's never a dull moment. So I'm thinking, okay, well, good. Apparently Trump pulled it off with this Iran deal. We're going to go to Switzerland, apparently. J.D. Vance and Kushner, I understand, are on their way there currently. So when I get up this morning, I look at my phone, and what do I see? Iran closes the Strait of Hormuz. I go, oh, my gosh. Maybe this is an old article. Nope, not an old article. It's not. So what happened here? Well, the Iranian security officials said that they had closed the Strait of Hormuz, citing what they said was a failure, U.S. failure to stop the fighting in Lebanon as required under the agreement signed earlier this week by President Trump. Now, the thing is, this is fighting between Israel and Hezbollah. And, Vance was on one of these TV shows. I forget exactly which one I heard him on. But in this case, ceasefire, at least as far as these negotiations are concerned, a ceasefire really is not a ceasefire. Sometimes the ceasefire is just going to be you got to shoot a little bit less at each other. And that's ultimately, I think, what we're going to have to, or Iran is going to have to accept. Not at the same time, though, here. Look, oil prices, from what I understand, are already seeing some price action upwards, which is not, ideal, because we saw one heck of a rally this week. Why? Because the price of oil went down, and it dropped almost 10% this week, which is phenomenal. And of course, as oil drops, markets are going to skyrocket. They really are. So what do we do? As investors, right now, you think, well, should I play oil? Should I play this? In this instance, your best defense against market volatility is a properly risk-adjusted and diversified portfolio. That's it. You don't have to get cute and try to, let's pick this missile company. Let's pick this. No. Broad-based ETFs. For those of you who, let's say you're not a client at DeGreen, that's okay. I still love you. Let's say, if you're not, and you do invest in broad-based index funds, for example, the S&P 500, that is a broad-based index. You can even do other countries. You can do certain sectors. But really, if you take a 10,000-foot view, that is the way to go about it. why it's going to dampen a lot of the volatility that we see in markets today. Because again, right now, everything is being driven by oil prices. Sure, when the Fed came out earlier this week, and they did, we got to hear from Kevin Warsh. We'll talk about that, but there's certainly been a regime change, and a lot of it, I think, for the better. But again, markets didn't necessarily like what Warsh had to say. But still, markets recovered. But I expect, given the news that we have learned at least overnight, it could be a choppy week. It could be. But then again, we have seen things get sorted out. We have seen things, iron themselves out. And I truly do hope this whole thing does. At the same time, Iran really does not want a deal. I mean, I know I don't need to tell you that, but Iran clearly does not want a deal. Iran, for example, just days prior to the deal being signed, Iran imposed new procedures, including a demand that ships register to cross the Strait of Hormuz 2 days in advance. So already that's going to add more uncertainty into things. They're picking on different ships. That's not going to work. That's not going to work. And the U.S. is not going to accept that either. So I still think my recommendation here on this, in terms of geopolitics, not that anybody's asking for it, but you're going to have all of these top Iranian officials on a plane here pretty soon. Shoot the plane down. Start over. Shoot the plane down. It's drastic. But I don't like having to negotiate with Iran, and I don't think we should. That said, I don't want markets to suffer any more than they already have. But please, do not try to get cute with markets. If you do that, you're going to get run over. I've seen it time and time again. Your best risk control mechanism is a risk-adjusted portfolio, and one that is tailored precisely to your needs, which is what we do for our clients here at DeGreen Private Wealth. So it's going to be a busy week, but there is something, despite all of the geopolitical tensions, that does have, I believe, the opportunity to really boost markets in a way that we had not seen for some time, at least for a few months. And that is Micron is going to be reporting earnings. Now, for those of you who have not followed Micron, if you take a look at its chart, you're going to get vertigo. It is unbelievable how much Micron Technologies has gone up. Now, you might say, well, Sam, your ETFs, you don't want to buy stocks. You're right. I'm not saying buy stocks, but what a stock can tell you, what a company can tell you about the overview of a certain sector is invaluable. It's going to tell you exactly what consumers are doing. And Micron has been phenomenal. They've been absolutely phenomenal in terms of selling microchips. Now, if Micron blows it out of the water, if they report a earnings beat on the top and bottom line, and they give good forward guidance, and that's really what the market's looking for. If they give positive forward guidance, I would expect the chip companies and all of the other companies that are, that benefit from that, I would expect that to drive markets substantially higher. I would not be surprised if the S&P 500 saw another 3, maybe 4% gain as a result. So whatever happens here with Iran, and eventually it will get sorted out, you know it will. Hopefully it will. Hopefully it will. And I'm rooting for Trump, obviously, and I'm rooting for a military victory. Incidentally, just as an aside here, You see the critics of Trump on the Iran, on this Iran conflict, on this Iran war, whatever you want to call it. We did not lose militarily. We do not lose in terms of military conflicts. We don't lose. This is a political loss. Our military absolutely decimated Iran. They wouldn't be asking for $300 billion to help rebuild if they were as good as they say they've been. They're not. Militarily, Iran has been totally neutered. Now, it's not to say they can't cause damage, but it drives me crazy when people call this some sort of military loss. It is not a military loss. Just like you could argue Vietnam was, and this is something my dad would always say, is that, the Vietnam War was not lost on the River Mekong. It was lost on the River Potomac. And I honestly, that's what this feels like. It feels like there is a lack of political will. So I really do think that's an important distinction. But not that anybody's gonna hear. It's okay. It's okay. But folks, whatever happens this weekend is probably gonna be choppy given all that we have seen. You need to remain, or you need to be invested in a portfolio that is tailored to meet your individual needs. That means for example, you're going to need to take money from your retirement portfolio. Is your portfolio lined up appropriately for such a goal? Let's say you want to take a bunch of different trips. You've got some spending that you want to do early on in retirement. And frankly, that is where most of the spending takes place, by the way. After the first few years of retirement, people get into the routine. Your spending tends to drop way down, which is why early on in retirement, number one, you need to guard against losses. And if you do experience a market downturn, even a temporary one, it is crucial that you have a cash reserve to draw on so that you can take the burden off of your portfolio. All that is going to do is allow your portfolio to recoup quicker. And when your portfolio recoups quicker, of course, what happens? You make more money. And I don't know about you folks, but I like making money, and I like when our clients make money. So whenever I meet with clients, whenever I meet with potential clients, one of the things I'm always going to ask about is that cash reserve. And let markets remind you, when possible, that cash reserve is something that you cannot overlook in retirement, especially early on in retirement. So if you take away one thing from this show, and don't worry, we got 2 hours together. So there's going to be hopefully a lot more good stuff. There is going to be a lot more good stuff. What am I saying hopefully for? I'm in charge of the program. Come on, Sam. Prudent and thoughtful investment strategies will always pay off. But it takes investment discipline. It takes emotional discipline. So whatever happens here, as a result, could this be an escalation? Could Iran be doing this? And I actually don't think this is out of the realm of possibility. And I'm getting a sneaking suspicion. Iran is not in Switzerland right now. It would be an embarrassment, or at least from Iran, I can see them saying, you know what, let's embarrass Trump. Let's just not even show up in Switzerland. I could see it. So, does this get solved over the weekend? Hopefully, but probably not. I got to take a quick break here, folks. But I want you to keep in mind as we talk about what's going on in the world, your best tactic, the best strategy that you can employ is a proper investment discipline, meaning you always make sure you're in a level of volatility. You keep your volatility that is appropriate for you. You keep your fees low. You keep your positions transparent. That is, you know what your funds own. You do a whole bunch of things, all of which we do here for our clients at DeGreen Private Wealth. Our number, 480-771-7000. That's 480-771-7000. I got to take a quick break, but more on, and I want to talk about South Korea too, because their market's up 200% over the last 6 months. everybody's missed it. Stay tuned, folks. I got a lot to talk about. I am investment advisor Sam DeGreen on News Talk 550 KFYI.
Phoenix.
Welcome back. I am investment advisor Sam DeGreen, and look, today's show, there's a lot of geopolitical uncertainty. Now, I'm not just talking about the Iran war. Now, one thing that despite all of the news that seemed to not maybe get as much attention as it could have otherwise. I don't know if anybody, you can look online, but you can see the Ukraine. You can see Ukraine hit Russia's oil refineries with drones. And the explosions were absolutely catastrophic. Russia right now is experiencing quite some serious fuel shortages. There are lines all around gas stations in 53 different parts of Russia, major areas. I mean, it was, if you saw this refinery blow up, it was like somebody, have you ever, probably most of you haven't, but if you have, you've taken a water bottle and you twist it, and you keep twisting it, you keep twisting it, you keep twisting it, and finally the cap blows off. That is what this looked like, except the cap, in this case, was probably a multi-ton piece of steel that shot probably 300 feet in the air. I mean, it was, holy moly. I've never seen anything like it. So what does this have? So this will have an impact. Of course, if Russia's going to need oil now, they're going to have to get it from a already tight market due to the Iran closure. So is this going to increase the price of gas? I would say probably yes. Yes. So again, what are the things that you can do to protect yourself? Well, always during periods of volatility, and I'm going to keep hammering this home, a cash reserve. And you might say, well, okay, but I want that cash to work for me. I understand that. You want that cash to work for you. But you want that cash to be available. That's the most crucial part. If it's earning, 2% at the bank, just sitting there looking at you every day when you log into your bank account, that's fine too. The point is, that cash reserve is meant to act as a barrier between events like what we're witnessing here in Iran or in some of the fallout from Russia and other geopolitical events, and sometimes just general market downturns. But I cannot emphasize to you, whether you have $500,000, whether you have $1 million, whether you have $2 million, $10 million, a cash reserve is vital to your longer-term investment goals and objectives. It is vital. So for those of you getting ready to retire, and there are many of you, you finally said, I've had it at work, I can't deal with it anymore, I'm on summer break right now, and honestly, I can't. I don't want to go back to work. I think this is it. I think I'm done. Well, in that case, if you have a 401k, how can you protect your 401k? How can you protect your IRA? How can you protect the trust that maybe you have, or the just regular individual brokerage accounts? How do you do that? Well, first and foremost, and I know you've heard it a million times, you got to be diversified. You got to be diversified. Well, what does that even mean? Diversified how? You can be diversified across different sectors of the economy. Sure, you can own AI, you can own, things like Walmart, you can own, your giant chip companies as well. Is that being diversified? Well, it's better than nothing. But at DeGreen, we invest across all 4 of the major asset classes. So not only are we geographically diversified and across different sectors, but also across different asset classes. So we have fixed income. Those are your bonds. You have alternatives. Those are your non-correlated market assets, and they're boring, but they're there to add stability to a diversified portfolio. So you have fixed income, you have alternatives. What else? You have cash. You have cash. Yes. Always have just a little bit of cash depending on your needs, will always have anywhere from 1 to 2% worth of cash, sometimes more, sometimes less, but generally we always aim for at least 1% in cash. And that's good. We want that. And then equities. Equities, stocks, your Microsoft, your Nvidia, your SpaceX. So fixed income, alternatives, cash, and equities. FACE. When you are invested across all four of the major asset classes, for example, if equities go down, well, typically people are going to rush to bonds, which is going to drive the price of bonds higher. Which means if you own a portfolio of stocks and bonds, when your stocks hit the skids, and that tends to happen on occasion, not right now, and I'm loving it, but on occasion, well, okay, you want your portfolio to still be moving forward. You want to still be making money. You still want to be on the right track. Well, that's where a diversified portfolio comes in. As stocks decline, bonds go up. As bonds decline, because people are selling bonds, well, that money's got to go somewhere. That's always an important thing to keep in mind. When you see a sell-off in a certain industry, when you see a sell-off in a certain sector, you have to remember that money is not just leaving. It is traveling somewhere else. Always. That money does not just get sucked out and not go back in. It is always going somewhere else. So if you have a broad-based, diversified portfolio across all four of the major asset classes, and you own, for example, emerging markets, developed markets, U.S. markets, Brazil, you own a little piece of Saudi Arabia, you own all different parts of the world. Now, earlier this year, it's a great reminder, the United States, the chip sector, really wasn't performing very well. In fact, the United States, the S&P 500 and even the NASDAQ at the time were pretty dull. Well, again, you need your portfolio to always be working for you. So that money went out of the U.S. It went somewhere. Where did it go? It went to emerging markets. Well, our clients, they own emerging markets. And they experience a piece of that growth. Developed markets were also picking up the slack. And in fact, right now, I'm reading all about how analysts are now once again looking at international developed markets. Of course, valuations are they're not super, they're historically sure they're high. You have to also take into account interest rates and things like that. But so you get a lot of people who might be hesitant. Oh, I don't want to jump in at the top. Knowing my luck, it's going to go down. Right? There are many of you who think that way. Well, then, okay, well, be overweight. For example, your developed market, your emerging markets. Developed markets, for example, own South Korea. Now, South Korea is a pretty small little area, that's for sure. It's not, it's not going to get a ton of attention. But their overall market right now is up 218% over the last year. Why? Because there's shifting changes. Money that was once in energy, money that was once in more defensive names, has begun flowing into South Korea. Well, why? Because they own a lot of chips. They're needed for a lot of the manufacturing process. And there's also been some major reforms in South Korea. Now you might say, well, how do I even own positions in South Korea? Well, our portfolios do, and they own it through their emerging market and developed market positions. So having a diversified portfolio means you will always have a piece of the world's most promising markets. Always. You will always be allocated, because money flows, or, money is always looking for the best return. So as a certain position, for example, gets bigger in, let's say, our emerging market, South Korea becomes a bigger and bigger part as more money and money flows into our developed market positions. So this is tremendously beneficial for clients. And that's the way indexes work. The losers naturally get left out. The winners always rise to the top. So you're going to own SpaceX when it hits the NASDAQ, or our clients will own SpaceX. And again, just going to say it, if you're going to buy SpaceX, please just wait. Just wait. Wait 6 months. Wait a year. Wait a year. Because time and time again, IPO after IPO, it has been proven that you are better off just waiting. Just wait. Let SpaceX at least have one earnings report before they come out, before you go out and buy a ton of it. That was my recommendation. And while I get it, you saw SpaceX go up, just wait. Just wait. There's always a boat. You haven't missed the boat. With markets, there's always boats. There's always opportunity. And that is, again, I mean that when I say that. That's what our whole program is designed around, and it is the idea that there are always opportunities all around the world, and it is easier than ever to invest in those. And that is what we do for our clients. Now, I got to take a quick break, though. 480-771-7000. That's 480-771-7000. It is a privilege. It is an honor. And I mean it. It's a lot of fun to meet with people who listen to the show when they can or every week. And I sincerely hope that you will give us a call at 480-771-7000. And that we can schedule a time for you and I to sit down and come up with an income plan, come up with a portfolio plan, and just let's allocate those funds, your funds, the ones that you have worked so hard for. Let's allocate them for success, to deal with markets choppiness, to deal with whatever markets throw at us. I got to take a break. 480-771-7000. Stay tuned. I am investment advisor Sam DeGreen on News Talk 550 KFYI. All right, welcome back, folks. Welcome back. I am investment advisor Sam DeGreen. And look, I know we talk about world events, we talk about all sorts of things, and the reason I mention all of these events, the reason I mention what's happening in South Korea, for example, and we'll dig into a little bit more later, but the reason I mention all of these things is because they all matter. The reason I mentioned what's going on in Iran, well, of course, you know it matters, but it matters in this context specifically regarding your portfolio. Look, one of the things that we're going to see more often now, and this is new. This is not something that has always happened in markets, but it's just the new norm, and you need to be prepared for it. Markets are going to be more volatile. They're going to be increasingly volatile, and they're going to be more volatile on a permanent basis, not just when things get really dicey or when, certain events happen like COVID or something like that. Any sort of downturn that we experience in markets or any sort of hiccups that we experience in markets, you're going to see quick movements, either to the upside and to the downside as well, but mostly to the upside. So you have to maintain discipline, investment discipline. You have to know, you have to be in a portfolio that first and foremost is appropriate for you. Because if it is not appropriate for you, when those times come where markets experience a temporary pullback, people become prone to making, irrational decisions. And you might say, well, I wouldn't do that. I wouldn't do that. You might not when you're working. You might not when you are working. But it becomes a different animal entirely when you are not working, when you do not have that paycheck coming. Because right now, while you're working, you think, well, it's good. I'm buying low. Sure, that's true. But it is an entirely different thought process when you enter retirement. So making sure that you're in a portfolio with an appropriate level of volatility. There's going to be there's going to be volatility no matter what you do. There's nothing you can do to defend against all volatility unless you just keep your money in the bank. But in that case, folks, you're just going broke slowly. Excuse me, not slowly. You're going broke safely. So sure, we want some money in cash, of course. But if, like millions of other people, you need that portfolio for retirement, it's paramount that you protect it, that you take the correct steps, not only to protect it, but to make sure that it grows, that it has recuperative properties, that it can ultimately withstand whatever markets throw at it. One of the things that I love and I'm very, very proud of when it comes to our portfolios is they have long-term performance and volatility track records. Now, that might seem, oh, well, that's cool, Sam. That's, really interesting. Anyway, I get it. But what most major brokerage firms, or what, Schwab, Fidelity, all of these companies are going to do is when you meet with an advisor at one of these bigger firms, or even some of the smaller local firms, they're going to sit down with you, they're going to type in all their positions, and they're going to say, here's what we would have done if COVID happened today. Oh, well, here's what our portfolio would have done. As you can see, blah, blah, blah. That's so, you can put whatever you want in the computer and make it come out however you want. But that's not representative of what actually would happen. You don't know what your advisor would do. The importance of having a long-term performance and volatility track record is I can look at our team and go, this is how they responded in 2008. This is how our portfolios responded in 2008. Wow, it took the S&P 5.25 years from peak to trough in 2008 to get back just to break even. But it took our most aggressive at DeGreen portfolio less than 2 calendar years to get back to break even. So there is a point in having those long-term performance and volatility track records so that we can know when you and I meet and we say, okay, let's discuss your thoughts on markets, your feelings on markets. I'm going to ask you some questions, and they're not designed to trick you, but they are designed to look for inconsistencies. And the reason being is because if expectations are not crystal clear, and if we don't discuss these things beforehand, when things do get dicey, well, then it's not very fun. Not very fun for either party. So making sure that you are prepared, making sure that we're doing the right thing for you before things get choppy is crucial. We're big on being proactive here. Now, there's some advisors who will say, well, you know what, that long-term performance volatility track record, Sam, that is impressive. But you know what? I have an annuity that I can sell you. Okay. I have spent a good probably 15 hours this week on the phone with annuity companies. With annuity company. Why? Because either there's annuities that are out of surrender in which the client goes, I want out. Or there's some with even surrender penalties, but the fees in these annuities are just, look, folks, I don't care if you don't, I do care. I want you to come to DeGreen Private Wealth. But if you just even take one thing away, please do not buy an annuity. They are such rip-offs. Look, doing this for 10 years, however long I've been doing this, long time, and meeting with as many people as I have met with and talking with as many people as I've talked with over the years, which is a lot. And growing up around this, I am telling you, I can count on one hand. I can recall their names. I can count on one hand the people who I have met with who would have been suited for a portfolio. Suited for an annuity, where an annuity would have actually made sense for this particular person. There's one person, they had about $1 million. And when markets would move 0.1%, we'd have just a normal day in markets. And let's say it was just a slight down day, down 0.1%. Nobody would even, it doesn't even register. Because again, markets, they fluctuate. Would call me in tears would call us in tears. Oh my gosh, I'm down $1,000. What's a $1 million portfolio? That is a person where an annuity would have made sense. That is a person where we're investing just, it wasn't for them. That is such a rare case. It is a very rare case. The amount of people, though, that come in their 40s, early 50s, maybe late 50s, even in their 60s and beyond, they come to me and there's never just one annuity. It's like crack. You never just once. Because once an advisor gets a commission, oh my gosh, they're getting steak. They're getting a nice cut of steak that night. A very, very nice steak. Fleming's. Or nicer. So, protection does not mean buying an annuity. That is the opposite of protection. In fact, all it does is lock up your money, charge you excessive fees, and you're going to hear annuity people, they're going to say, well, there's no fees, and there's this and there's that. It all comes at your expense. The most popular product in the world right now for annuities, the most popular annuity product, is what's called a fixed index annuity. So what these products are is they say, well, okay, we're going to buy the S&P 500 and we're going to guarantee you 6%. That's right, 6%. And you get to participate in 50% of the upside up to 10%. They'll do those types of things too. But let's just keep it simple. We say, okay, you're going to get 6%. And your portfolio will never, ever go below what you invested in it. In fact, there's anniversary dates where, let's say if on year 3 your portfolio gained 10%, well, good. That's now your new basis. Means you permanently made money. Okay, great. Here's what the insurance companies do. Because annuities are not investment products. They are insurance products. Why? Because they offer a guarantee. Now, again, that guarantee comes at your expense. So, an annuity company or these insurance underwriters and the people who develop these products, they know that if they look at market history, they say the S&P 500 has done about 8% per year. Well, that's great. Awesome. But in recent history, it's done far more. We're almost double digits. So let's call it 10%. The S&P does 10% over the last 20 plus years on average. So if you're guaranteed 6% and the S&P 500 does 10%, well, great. You've made your 6%. But what about the rest of the performance? Again, you own an indexed annuity. It's tied to the success of the S&P 500. So what happens? Well, they take the rest of it. They'll take that 4% from you. So instead of getting 10%, you got your guaranteed 6%. But it came at the expense of everything above 6%. Folks, they are such scams. They are total garbage. I'm telling you. Look, at DeGreen, we offer a well-crafted, carefully crafted portfolio, a highly diversified portfolio of transparent, tax-efficient, U.S.-traded, exchange-traded fund. And exchange-traded funds. And the reason we do that is because all of those things are in the client's best interest long-term. They provide growth. They keep fees low, which means more growth. They keep taxes low, which means you keep more of your money. Everything we do is designed to be in the client's best interest because this is a long-term investment program. I'm not here to make commissions. I don't sell commission products. I don't make commissions. And the reason being is because I believe that is in the long-term interest of the client. I am confident that our program can and will help you, but you just have to call 480-771-7000. And while this show is for everybody, our investment program is limited to those with a portfolio of at least $500,000. If you qualify, if you meet that investment minimum, please do not hesitate to give us a call at 480-771-7000. That's 480-771-7000. Or you can dial it and hang up. That way, at least you have the number, because come Monday, you're going to make that call. Maybe you're busy now. Maybe you're driving. Maybe you're with your grandkids. God bless you if you're listening with your grandkids. 480-771-7000. Dial that number. At least then you have it in your phone. Dial it, hang up. Boom. You know it. 11:48 this Saturday. You made an important call in securing your financial future. Stay tuned, folks. I am investment advisor Sam DeGreen on Newstalk 550 KFYI. All right. Welcome back, folks. Welcome back. I am investment advisor Sam DeGreen, and I'm loving to see that phone ring. 480-771-7000. Look, 2026 must be the year in which you take action. As I mentioned last segment, look, markets are going to be more volatile. And there are going to be, just by their nature, you have machine trading that actually accounts for about 80% of all of the price action that you see daily. To give you an idea here on how big Wall Street is and how big capital markets are, more money changes hands in 15 minutes on Wall Street than does all of Vegas the entire year. So think about that. You have essentially the same amount of money traded in 15 minutes than Vegas trading hands all year. Now, a lot of that, again, is machine driven. Now, that's not to say that's a bad thing. In fact, it's actually probably a good thing. Number one, computers are stupid. Computers make mistakes, and computers also create opportunities. Because when sell-offs occur, and this happens in major indices as well, when those computers say, we're on a downtrend, let's sell, they always overdo it. They always overdo it. Well, that creates a great entry point. But it's also, again, if you're already invested, it's not something to worry about. It's not. So, protection here, folks, is not buying an annuity. That is not protection. That is sacrifice. You are sacrificing performance for a mediocre guarantee. For mediocre performance. A lot of times annuities will say, okay, well, look, what we can do here is if you agree to invest in this annuity and hold it for 10 years, we'll offer you 65% participation rate. You think, whoa, 65%. Okay, what does that even mean? Nobody knows what these things mean. I have never had somebody ever come to me with an annuity and they say, oh, I have an annuity. Okay, what kind is it? I don't know. That's not a knock on people. I'm just telling you. Because what these people say and what the annuities actually, it's not kosher, as some would say. It's not. So when you're getting 10%, when there's a 10% market return and you get a 65% participation rate, well, that sounds great. Okay, but that means you're only getting 65% of the overall performance. So you are quite literally paying more, you're paying with your performance. So you can say, okay, well, I got my 6%, I'm happy. Well, great, but it would have been awesome if you did, 10% 3 years in a row as opposed to 6%. Now you might say, well, that protection is there for me. Sure, that protection, I suppose, is there for you, but also, folks, protection in a diversified portfolio. Now, again, I cannot offer guarantees. I can't. No advisor can. As a fiduciary, I cannot guarantee investments. It's just legally. As an investment advisor, you cannot legally do that. Annuity products can guarantee a performance. So sure, maybe that little bit of peace of mind helps, but just remember, it is not the insurance company keeping you safe. It is your money keeping you safe. Because you're paying for that. That downside protection they offer comes because they are taking a huge chunk of your profit, holding it away so that they know, okay, well, look, we're going to keep the extra percentage points each year. It is a ripoff. And I'm not saying this to knock annuities completely. I'm not. But what I'm saying is, folks, again, the amount of people that have come to me over 10 years, I can count on one hand the number of people who I would have actually slept well at night knowing I sold an annuity to. You can, with prudent investment management, with an advisor who is paying attention, who's not golfing on Wednesdays and Thursdays and maybe skipping Mondays. It's not a lifestyle, it's a job, and I love doing this. I love it. That's why I'm always at the office. In addition, I have 4 kids. So let's be honest, 4 kids, 5 years and under. And frankly, work is my quiet time. Work is my quiet time. This is where I recoup, and I love it. I really do, because I truly do enjoy this. And I sincerely hope, folks, that you will seize the initiative where you will let 2026 be the year in which you allocated your funds, whether they be in a 401k, whether they be in an IRA, wherever they are, that you allocated them effectively. You allocated them prudently. You put together a strategy, or we helped you, obviously. That's what we're here to do. But where you came up with a strategy where you don't have to worry about this hanging over your head day after day, night after night. You go, oh my gosh, I'm going to retire soon. What should I do? Well, I'm going to sit around and think about it. Don't do that. Don't be that person. Take action. 480-771-7000. And look, while this show is for everybody, it always will be. It always has been. Our investment program is limited to those with a portfolio of at least $500,000 of investable assets. If you qualify, do not hesitate to reach out, because 2026 is going to be the year in which you dial 480-771-7000. That's 480-771-7000. You go, I've been listening to Sam. I've even been listening to his dad. I liked his dad. I like his dad a lot more than him. Okay, fair. But you like me too, right? You like me too. So you call 480-771-7000. And you say, you know what? I'm going to take the initiative. And I am going, oh, I love it. See, that phone's ringing. That's what I want to see. 480-771-7000. That's 480-771-7000. Finance should not scare you. Your retirement should not scare you. It's an exciting time, but you only get one shot at it. So make sure, folks, that you have an advisor who's working for you, a fiduciary investment advisor. 480-771-7000. I'll be back for hour number 2. I am investment advisor Sam DeGreen on News Talk 550 KFYI. Oh my goodness. Can you believe it? It's already hour number 2 of these, the 2 most important hours in radio freedom through finance. And folks, again, we're going to just jump right back into this. First of all, I love you. Thank you for tuning in. And as always, we are here live from the intergalactic headquarters of DeGreen Private Wealth at the beautiful Scottsdale Professional Center right here in your own backyard. Scottsdale, right here on Raintree and 87th. So right off the 101. So there's no excuse. There's no excuse not to take precise action, to call 480-771-7000 to schedule your one-on-one serious diagnostic interview with me, investment advisor Sam DeGreen. We're together. You and I are going to sit down. We're going to discuss your needs, and I'm going to learn about you. That's what we're here to do. And if you are a fit for this program, and more often than not, that is the case, if what we do is right for you, then we will discuss which one of our carefully, or which combination or hybrid of our portfolios is right for you and your family. Because again, folks, you get one shot at this. You get one shot at retirement. And there is a critical period of time in retirement, and that's your first, let's say, 4 to 5 years. Managing that making sure that you do not suffer any sort of serious downturn in which you cannot recover from. But if you are prepared for anything like that. Now, I know I focus on it's a bull market, and as I was saying to you all earlier this year, look, it's an incredible market. We are on that ground floor of the next great American bull market. So, Sam, if that's true, and you kept saying that, why are you talking about downturns all the time? Because downturns early in your retirement can spell trouble if you are not properly allocated, if you are not, if you're not in a portfolio that has an appropriate amount of volatility, given your longer term objectives. And if you're not prepared, folks, really it can create a lot of problems. And we're a proactive investment advisor. So yes, I would love to sit here and tell you that markets are up, and they are. Our portfolios are up, and they are. I love it. And I think our clients really do too. But with that said, folks, for you, if you're not a client, and you should be by dialing 480-771-7000, if you have to make sure that you are allocated effectively. And I spent last two segments going on about annuities because I spent a good portion of this week on the phone with annuity companies, going through annuity contracts, speaking with clients about the annuities that were sold to them. And folks, 99 times out of 100, I mean that, 99 times out of 100 here, the annuities that are sold to clients, it's never just one, by the way. You'll notice that advisors like if your advisor right now, have they sold you more than one annuity? Because nobody ever just stops at one annuity. They sell multiple different ones to you. Why? Because they get commissions on that. They get serious commissions on that. Now, that doesn't matter. They can call themselves a fiduciary all they want. If you're selling commission products and your advisor has purchased multiple annuities for you, right there, I would push back and say, no, you're not. Look, I have a friend of mine. When I first came back to Arizona, this was a long time ago. And he worked for Wells Fargo at the time, and he sold some annuities to clients. And he met, as part of their private wealth, so he met with a lot of the bigger elephants. Met with a pro golfer. Sold this guy a $50 million annuity. All sorts of different riders and so on. I mean, we're talking, it was huge. Pro golfer. And I said, oh my gosh. I said, what'd you earn on that? For at least the next 10 years, that dude is earning at least $500,000 in commissions. At least. I'm sure it's more than what he told. I'm sure it is. Now, there's nothing wrong with earning a living. That's not what I'm at. In this case, that might have made more sense for a variety of different reasons. I don't know the guy's circumstance, so I can't judge. But I'm telling you, if somebody came in, the annuities that I see, there's always a better way to do things. There always is. And that protection that annuities offer, folks, they're just taking a chunk of your performance every year, and then they're saying, well, we're going to swirl that away. So if there is a market downturn, well, guess what? We have your own money. We have the money that we've been siphoning off the top. And look, yeah, now we can protect you. I mean, it's really pretty ingenious the way they sell them. But they are convoluted. And most importantly, folks, when you put your money in an annuity, that's it. At least for a number of years until you can pull out of that sucker without getting dinged massively. There is just no reason in today's age, with all of the different investment strategies, with all of the information out there, and look, I'm not the only good advisor out there. I'm not, I know, surprising. But if you're looking for a good advisor, you should call me first. 480-771-7000. There are other advisors out there that do good work. You don't have to go with somebody who sells annuities. You probably shouldn't. And the reason these advisors will sell multiple annuities to the same person is to generate different commissions. That's it. And of course, if something happened, they could go, well, see, Your Honor, this is why I made this decision, because it was in the client. It's suitable for the clients. They use a suitability interview. Now, okay, it's legalese language. It might sound pretty straightforward, but here's the approach DeGreen uses, DeGreen Private Wealth, and the one that my dad would use as well. And that's if you wouldn't sell this product to your family, if you personally wouldn't buy this product, if you were in a client's shoes, you will not sell that. You don't sell that product then. You don't. You don't. And all of these advisors say, well, that's what I would have. I don't know any advisors who own a lot of annuities. I would ask why. If they're so great, of all the advisors I know, why don't any of them own annuities? Aren't they awesome? So yeah, I'm kind of mad that I spent so much time this week looking into different contracts for just to look into these things and go, this wasn't right. There was no reason for this person to have been sold this. This doesn't further their longer term investment objectives. And I'm not trying to be Mr. High and Mighty here. I'm not. But there really is levels. And it's becoming more common. Now you hear me mention, if you listen to this show, you'll hear me mention 401ks. Number one, 401ks are by far the most popular investment vehicle. Why? Because more employers are offering them, and employers are increasingly having to contribute, a decent amount to retain employees, and that's great. You want that. It's great for the clients. So if you've accumulated a lot in your 401k, that's awesome. However, and this is one problem, this is one area where I'm pretty disappointed in Trump, because he allowed BlackRock, he allowed a lot of these private equity guys who wouldn't know their ass from a hole in the ground. He allowed them to come in and say, well, here's what we're going to do. We want to sell annuities inside of 401ks. Never mind the fact that 401ks, up until a point, really until you're about a few years out from retirement, and even sooner, honestly, they should be about growth. They should always be about growth, because, again, this is a huge chunk of money that you've spent a number of years doing the right things, saving, being diligent with, investing, doing the right things, constantly adding to your 401k. So there's over $1 trillion, well over $1 trillion, multiple trillions of dollars inside of 401k. So, of course, annuity providers would love to have you buy an annuity inside of a 401k so that they can say, well, here, we're actually making this more like a pension. Now, if you are in the military, or if you're with the police or with your Arizona State retirement system and you have a pension, love that pension. It's awesome. It's great. There's a reason, though, pensions don't exist anymore. It's because, frankly, they're always underfunded, and generally the promises are never really kept. Now, I'm not saying that's the case with annuities here, but people are trying to turn 401ks into defined benefit plans, which are pensions. Defined contribution plans, or 401ks, they're totally different animals. One's has a defined benefit. It's exactly what it sounds like. And the other has a defined contribution by the employer. So if you got a pension, great. Great. More often than not, you should probably cash out of it. Always take the lump sum. It's just easier to do. And it's, frankly, financially, it's the best. Most of the time, it's going to be the best way to go about things. So, look, I'm not here to just bash annuities. I have something better. We have something better here at DeGreen Private Wealth. We have a tried and true team, a very, very experienced team in our back office, Efficient Market Advisors. Incidentally, the head of Efficient Market Advisors, his son is now is there. But Herb Morgan, who started EMA and who worked with me for a very, very long time and worked with my dad as well. So we continued on with them because they're awesome. But the reason I bring this to you is because Herb is actually running for the Comptroller of California right now. And I think he has a chance to actually beat the DEI candidate that they have running for the Comptroller of California. And I think that would be a very, very big win for fiscal discipline. So again, EMA was started by a very, very smart guy. And again, their family continues with it, and they're owned by Cantor Fitzgerald, who also works with President Trump. So a lot of good people. And again, I'm not tied to them. I hire them because they do good work. If they stop doing good work, I'd fire them. As an independent advisor, I can do that. But again, if my products were not good enough for my family, I certainly wouldn't be on the radio telling everybody, hey, call 480-771-7000. If I personally wouldn't buy them, I'm not going to sell them to you. But I am proud of these portfolios. I have seen them time and time again, not just thrive, but when they do take a hit, like everything else, they recoup. And they have those long-term performance and volatility track records, which allows us significantly more insight into gauging risk, into what level of risk is appropriate, and so on. So it gives me, the advisor, a lot more insight, which allows me to help clients far more. So, folks, look, those aren't the only two options. That isn't the only option for protection annuities. A smart, proactive advisor who is always watching these portfolios. And why? Because it's my money too. So when clients say, did you see what our portfolio is doing? Yeah, I did, because I looked at mine too. So yes, I know what our portfolios are doing. And sometimes people call and say, man, look at our portfolios. And it's a good thing. I love that. I go, I know. It's great. But folks, the reason I tell you all of this is because there's never been a better time for you as a retail investor. You have never had more investment opportunities and investment tools at your disposal. Now, you got to know how to use those tools, but advisors have never had more tools and have never had more information to work with. So if you are at a point, folks, where you need an advisor, where you need a trusted fiduciary, and not just a fiduciary in name only, which is frankly far too many of these advisors. When you are a fiduciary in name only, you tend to sell a lot of products that ultimately you would never personally buy. But when you need somebody to be a trusted steward of the wealth that you have worked so hard to create for you and your family, you want a true fiduciary. Somebody who is not only incentivized to do the right thing, but whose entire business is designed to be a long-term investment program. I'm not here to make a quick buck. I love what I do. And this is how I get out of the house each day. So when you call 480-771-7000, that's 480-771-7000, not only are you helping me escape my children who drive me up the wall, who are so cute, and I love them so much, and they're awesome, but they're 5. It's 4 kids under 5. So you're doing me a favor, and in return, I will do you a favor. And that is, I look forward, folks. I really do. I look forward to meeting with the people from this show, with the callers from this show. And I do. I love meeting with the people. I sincerely hope that you take this opportunity to give us a call at 480-771-7000. And you give us a call, and we can get you in to a portfolio. and into a program that is designed and tailored to be in your best interest all of the time, not just some of the time, but all of the time, and where you can build a long-lasting and trusting relationship with your advisor, me, investment advisor Sam DeGreen. Our number, 480-771-7000. That's 480-771-7000. You can also go to our website, DeGreenPrivateWealth.com. That's DeGreen, Private Wealth. And Dad, you know what? You're listening. Happy Father's Day, first of all. But I would really appreciate if I could get DeGreen.com. You're not using it, let's be honest. And I'm sick of saying DeGreen Private Wealth. It's an awesome name. Just maybe DeGreen.com would be a great little Father's Day gift. I'm just throwing that out there. Okay? Just throwing that out there. Either way. I like my dad. All right. 480-771-7000. 480-771-7000. Give us a call, folks. Let's get started. And let's start making some money. I am investment advisor Sam DeGreen on News Talk 550. KFYI. All right, welcome back, folks. Welcome back. I am investment advisor Sam DeGreen. And just a reminder that all of our most recent past shows can be listened to commercial-free, on demand, as they were meant to be heard at DeGreenPrivateWealth.com. That's DeGreen PrivateWealth.com. You can also go to iTunes. You can go to Spotify. You can go anywhere where podcasts are and type in Sam DeGreen, or you can type in super good looking guy and I will pop right up. Boom, right there. You can type in investment advisor and I will pop up. No, not that broad. You got to type in Sam DeGreen. Just do that. It's easier. Sam DeGreen, or Freedom Through Finance, as this show is called. And the reason we call it Freedom Through Finance, folks, is ultimately that is how one achieves their freedom. It is through finance. It is through prudent financial decisions. It's through taking appropriate and prudent risks. And again, doing all of the little things right. Might not sound like a big deal, right? Oh, cool, you got low expense ratios. I don't even know what an expense ratio is. I got it. It might not sound as sexy as, I got this new stock that's going to go up 10 times what you put into it. Oh my goodness, you're going to make so much money. You're going to have to fly me out on your private jet. It's not the way we operate. Now, of course, if we can do that, of course I will. But the things that are going to benefit you long term are the things that are just naturally carved into our program. They are the foundation of our program. And let me give you just a few of those things. And again, folks, these will serve you whether you have 500,000, 600,000, or 600 million. If you've got 600 million, call me, 480-771-7000. If you've got 600,000 or 500,000, you can call me too, 480-771-7000. But the reason, again, all of these will help you. For example, tax efficiency. I hate taxes more than you hate taxes. I know you hate taxes, but I hate it more than you do. I promise you, I hate it. I have a pathological aversion to taxes. Now, there are some times where financially it does make sense to just say, okay, I'm going to bite the tax bullet. But we're not there. One of the things that people say is, well, Sam, I have a portfolio, but there's all sorts of, I have all these gains. I don't want to realize that. Well, folks, one of the things that we do when clients have that situation, we just transfer everything over in kind. We custody our funds at Charles Schwab. And if you're a Charles Schwab, if you have Charles Schwab already, you don't have to open up any new accounts. You don't have to do any of that, which is just something that always is fun. You just, boom, we use your Charles Schwab account and we can get started right away. But again, if you have, for example, maybe at Fidelity, maybe at Merrill Lynch or Wells or whatever, if you have a lot of capital gains and you say, I want to switch over, I know I need to make the move, but I don't want to get taxed out the yin-yang. Well, have no fear. One of the things that we do, in addition to managing the tax consequences of our portfolio carefully, is we also do something called tax loss harvesting. I'm not going to get into the weeds. If you want to learn about tax loss harvesting, have fun. It's honestly, it's one of the most important things that we can do, and we do it especially if markets go down and there's a position with a loss. What that allows us to do is not only offset future gains, but it also can allow us to offset up to $3,000 of ordinary income. And in addition to that, offset any dividend income for the year. Because again, if markets hit the skids, and I know we're in a bull market, so nobody wants to think about markets declining. But when things happen, folks, I do think it's important, if markets are going to insist on making us walk the beautiful walk through the mud, and we're going to be in a downturn. Well, great, let's take advantage of it so that we can offset future taxable gains, so that we can, again, be smart when it comes to managing tax consequences. And we will also talk about the different types of accounts that you have and what is a strategy here to, what is the most prudent strategy to withdraw your money from. Sure, accumulating is great. That's 90% of the battle. But the last 10% is what makes the difference between success and perhaps failure. And that is managing tax consequences. When you give money to the U.S. government, you know where it's going. It's not going to anything worthwhile. You're going to more leering centers. The Somalis love it. And a bunch of crazy people in California love our tax dollars. But I don't want to give them any more money. In fact, I want to do everything as tax efficiently as possible, and that is something we do. But in addition to managing tax liabilities and keeping that low so that you can make more money, what else helps you make more money? Well, keeping fees low. Well, you want to keep fees low. Now, for those of you who do not know, there's something called an expense ratio. An expense ratio is a part of every single fund. It's a part of every mutual fund, part of every ETF. It's what a fund charges to keep the lights on. So, for example, an average portfolio of mutual funds can charge you anywhere from 1% and onwards. Sometimes they're a little cheaper if you're lucky. But a portfolio of ETFs, for example, the ones we use, our entire portfolio, that expense is 7/100ths of 1%. Not 1%, not 70/100ths, but 7/100ths. That is a rounding error in many cases. I mean, not a rounding error, but it's pretty damn small. And I'm proud of that. I love the fact that our portfolios are ultra low cost and ultra tax efficient. Ultra tax efficient. So, folks, I encourage you to give us a call at 480-771-7000. No more waiting on the sidelines. If you've been waiting on the sidelines, just remember, there has never been a story, with a good outcome, that started by saying, yeah, I just waited. I just held off. I didn't take any action. I didn't make any moves. First of all, there's usually not a story, because most people, if they're fine with inaction one day, they're going to be fine with it the next. Let 2026, folks, be the year in which you finally take action. Not only is 2026, I think the rest of 2026, set to be a good year, but into 2027 and heck, even into 2028. Sure, there could be some volatility with the elections coming up and so on. But folks, there is more opportunity. There is more money to be made out there than there are, major risks. But you have to be appropriately allocated to take full advantage of them, and that is where we here at DeGreen Private Wealth can be of a special help. So again, 480-771-7000. While this show is for everybody, our investment program is limited to those with a portfolio or with investable assets of at least $500,000. If you qualify, please do not hesitate to reach out, 480-771-7000. And for those of you who've been putting it off for far too long, and you go, you know what, I'm out right now, I can't talk, but I'm going to call Sam DeGreen, because you know what? Ladies, give your husband the greatest Father's Day gift. And if he's not a father, that's fine too. Just celebrate it anyway. But give your husband the greatest Father's Day gift he could possibly ask for, and that is peace of mind. That is peace of mind. Men, that's what we want, right? Peace of mind. We don't want to have to worry. We don't want to do that anymore. So we call DeGreen Private Wealth at 480-771-7000. And if you tell your husband tomorrow, you say, honey, I love you. I skipped the cards. I didn't gift you anything, but I did make us an appointment for DeGreen Private Wealth because I care about our financial future together and because I love you. You're going to reduce his risk of heart disease. You're going to reduce the stress he's under. You might even see the hair that's been grayed due to stress and anxiety finally come back to that natural, rich color that you married him for. And that, you still see the faint outline of, but it could reverse grain. That is what a call to DeGreen Private Wealth can accomplish. But in addition to all of that, it can just help you accomplish your financial goals and objectives, which should be good enough. 480-771-7000, 480-771-7000. You can also dial that number and hang up. I wouldn't recommend it, but you can do that. Dial, hang up. That way at least you have that number. So when it is time, when you are ready to make that call, that you have it in your phone, ready to go, and you're ready to rock and roll. But please, seize the initiative. There is so much opportunity right now, and I want you listening, to take advantage of it. 480-771-7000. Back in a moment, folks. I am investment advisor Sam DeGreen on News Talk 550, KFYI. All right, welcome back, folks. Welcome back. I am investment advisor, and just a few seconds right before we went on air, there was a gentleman. He called. I saw his caller ID. And right now, he is on the phone with the one and only Lucas Hammond, who has been with me since I started DeGreen Private Wealth, and he is a bright young man, and he will help you get on the schedule. But folks, we're ready to take action. We're ready to get started. Look, summertime, and I'm telling you right now, there's something in the water, because more and more people, they're getting it. They're saying, let's call DeGreen Private Wealth at 480-771-7000. And that man who just called Richard, he is taking decisive action. Why? Because he doesn't want to have to worry about his finances anymore. He wants to retire. He wants to spend his time doing the things he loves. He wants to be out in the workshop. He wants to be hanging out with the grandkids. He wants to be traveling, seeing the great wonders of the world. He doesn't want to be glued to his phone going, what on earth did NVIDIA do today? Why is my portfolio up? Should I press harder? Should I soften up? Oh my gosh, could there be he doesn't want to have to worry about all that. And he wants to know that he can that when he does take smart, proactive action by calling 480-771-7000 to get started, to schedule that one-on-one investment suitability interview with Arizona's trusted premier, fee-only, and I would say probably fastest growing advisory, fiduciary investment advisor in Arizona. I can't speak for other states, but we are growing. And there's a reason. It's because our program, our philosophy, and our approach is straightforward. Now, that doesn't mean there's not a lot of complexities. No. But that's what we do behind the scenes. But our investment philosophy is very simple. It is put anything that is in the client's best interest that will benefit the client, do it. Don't ask. Don't wonder. Just do it. And when the small things are done consistently, they add up to significant savings over time compared with just your standard advisor. If you're going to pay your advisor to put you in mutual funds, not only are those tax inefficient, so you're going to pay more taxes, not only are there fees inside of the mutual funds higher, so you're going to pay more. So you'll pay more in taxes, you'll pay more for your funds, and in addition, you'll probably get worse performance. Why? Well, because you're paying more for a fund which more than likely is going to underperform the very same index that it chooses to compete against, and in all likelihood that DeGreen Private Wealth owns. We own what are called index funds, index tracking ETFs. Now, don't let it sound complicated. The S&P 500, for example, is an index. It is the most famous index in the world. Our clients hold the S&P 500 index. They also hold the NASDAQ. They hold developed markets, emerging market indexes, and so on. But inside of our well-crafted, diversified portfolios, you're going to own about 15 or 16 ETFs. It can vary, sometimes a little more, sometimes, not really less ever. But inside of your portfolios, inside of our clients' portfolios, they're going to own 7 7,000 individual positions across all four of the major asset classes: fixed income, alternatives, cash, and equities. Now, you might say, well, how the heck are you monitoring 7,000 positions? Well, folks, we monitor the ETFs. So again, inside of our portfolios, you're going to own a piece of all of the world's most promising markets, and you're going to have exposure to them. You're going to have exposure to the U.S. You're going to have exposure to SpaceX when it hits the NASDAQ here, in 60 days? Maybe a little bit more. You're going to have NVIDIA. You're going to have all of the parabolic companies that have just parabolic growth. And you're also going to own some more of the tried and true companies out there: the Walmarts, the Home Depots, the Lockheed Martin, whatever it is. You're going to have exposure to those companies. But instead of trying to pick winners and losers in single stocks and investing all of your money into one single company, which can generally be a disaster, people get attached to their stocks. People get attached to their positions. That position doesn't know your name. That position doesn't love you like I will. It's a fact. That position does not love you. You might love it, but it doesn't love you. And so a lot of times, especially in cases of inheritance, I've seen, not as much recently, but I have seen where people, they say, well, I want to hold on to it. It's done really well. I feel like we should hold on to it. And that's fine. We don't have to sell all of a portion of a stock you own. But ultimately, we need to do, first and foremost, and we'll decide together, if it makes sense to hold that position. If it makes sense, if we can still maintain an appropriate risk balance doing so. Because ultimately, folks, I'm here to make you a lot of money. I'm here to make you money. Frankly, our business doesn't work if that doesn't happen. And so everything that we can do to make you money, to keep more of your money in your pockets, and by that I mean literally keeping taxes low, keeping your funds tax efficient so that you can manage tax liabilities. For example, dividend income. You're going to get dividend income from our portfolios. Now, if there is a pullback, we can do what is called tax loss harvesting to offset that dividend income so you don't have to pay taxes on it. Again, it's just a fancy way of manipulating the tax code. Legally, it's perfectly legal. We do it all the time. When there's losses, we haven't done it. Again, I'm not going to apologize for not having losses, but that's okay. Look, everything that we do is designed to be in your best interest and designed to help you succeed. That is what this program is about. That is what a long-term investment program is for. And that's what I want. I just want the same thing you want, and that is to help you accomplish your investment goals and objectives with as little risks as possible along the way. And as I mentioned, diversification, those 7,000 individual positions that are in our 15 or so ETFs that we invest in, which we have narrowed down, incidentally, from, we probably looked 600-700 different ETFs, and ultimately we decide on a few of them, and we will routinely, if we feel that such a position is not suited anymore, then we sell it. And if we feel that something is suited to do very well, we buy more of it. It is a very, very straightforward investment program, because we don't need to overcomplicate things with annuities, which are total scams, frankly. We don't need to overcomplicate them. We don't need to overcomplicate your life. If we keep fees low, we keep taxes low, we keep your capital gains in check, meaning that we rotate and we don't create excess tax consequences for you, and we make sure that one position doesn't get too large. That's why we frequently, when warranted, will rebalance portfolios also to keep risk appropriate. So fees low, cost low, expenses low, and having a proactive investment advisor who is not only invested alongside his clients, as I am here, but who is also invested for the long term to do well over time. And each and every year you do those right things. Good decisions create good outcomes. It's just facts. Very simple philosophy. Good decisions create good outcomes. And the best outcome, the best decision that you can make, actually, is to give us a call at 480-771-7000. That's 480-771-7000. So inside of that diversified portfolio, whereas Klaus Schwab, that infamous, dumb, academic egghead, as Klaus Schwab would say, you will own nothing and be happy. I can't do a German accent. I'm sorry. You will own nothing and be happy. Well, that sucks. If you want that, go to another advisor. If you want to own everything and be happy, and actually be happy, and be wealthy, you call DeGreen Private Wealth. DeGreen Private Wealth. 480-771-7000. So you can own nothing and be happy. Sure, go do that. Or you can own a DeGreen portfolio and own everything and be happy. 480-771-7000. The choice is yours. Choice is yours. 480-771-7000. And again, you can also go to our website, DeGreenPrivateWealth.com. That's DeGreen privatewealth.com. And on that form, on that website is our contact form. And that contact form, for those of you who tend to listen to this show afterwards, and people do, they listen commercial free as intended. When you're doing that, and you're listening, and you're laying awake at night going, oh man, I can't call right now, but I know if I wait until the morning, I'm not going to do it. So I'm going to reach out to Sam DeGreen, and I'm going to fill out that contact form. It takes you maybe 3 minutes, 2 minutes, if you know how to spell your name. 2 minutes, very, very, not even 2 minutes. It's a very, very simple form. But ultimately, folks, it'll just allow us, you tell us how to contact you, and we'll contact you whenever you'd like. But ultimately, folks, it really hasn't. There's never been a better time in my career just in all of my career, where I have seen so much promise. If we had a new Fed chairman who is as awesome as Warsh has been, and again, markets didn't like his first conference, but whatever, they'll get over it, and they have. That alone would be justification for a rally. If we just had the tax cuts, that alone would be justification for a rally. If we had just the deregulation, that alone would be worth some percentage in the S&P 500 or in all of U.S. markets. So there are so many different things that and if earnings, again, last week, 80% of companies are beating earnings, 86% I think it was, are beating their earnings per share expectations. That is phenomenal. I've never seen it that high. That alone is enough for a bull market, a continued, long, and prosperous bull market. So again, while everything is good, you might say, well, I'm good. I don't need to do anything right now. Well, all the more reason, while things are good, you should position yourself to take advantage of them. If you are being weighed down by fees, well, suddenly your portfolio is not as good. Suddenly you're not making as much money. If you are paying more in taxes, well, yeah, you might be making good, but you got to pay a lot of taxes, which also eats up wealth, not just your portfolio, but general wealth. And if something happens to you, do you know that your advisor can be trusted to do the right thing by you and your family? Will they communicate with you? Do they communicate with you now? And I wouldn't blame them if they're not communicating now. It's super hot outside. Who the heck is in Arizona? Some of you are. And for those of you who are brave enough to stay in Arizona, I want you to call 480-771-7000. It's 480-771-7000. But this is a highly personalized and individual investment program that is tailored specifically to meet your investment objectives. I know, what a sales pitch, right? But honestly, folks, I love doing this. I really do. And I know that our program can be of tremendous help to you. So whether you have money in a 401k, which you can roll over into an IRA, whether you have a trust, whether you have an IRA, or all of the above, DeGreen Private Wealth is Arizona's premier, fastest growing, fee only fiduciary investment advisor, and that is a That is a standard. That fiduciary standard is one we chose for ourselves. We do not sell commission products, and we're not just fiduciaries when it suits us. We are fiduciaries all of the time. Because, again, I'm here for a long time, and I don't want to make any enemies with you. 480-771-7000. Folks, give us a call. Let's get started. I got to take a quick break. I am investment advisor Sam DeGreen on News Talk 550, KFYI. Can you believe it? It's already been 2 hours? Well, this is, again, I get it. Time flies by when you're having fun, but 2 hours. Just, oh my goodness. Folks, it's a weekend. It's a weekend, and right now you're probably doing all of the things that you've either been putting off or that you love to do. But one thing that you do need to do, and that you can benefit from, and that look, this program, the reason I started this business was to serve Arizona families. I saw my dad, attorney and certified financial planner, do it. I learned from him, and he threw me into the deep end. So I got one heck of an education working with him, and I'd always tell him, I'm the greatest business partner you'll ever have because I love you and I don't have the means to sue you. So on Father's Day, first and foremost, I want to say happy Father's Day to attorney and certified financial planner Keith DeGreen. And look, the reason I mention this is there is a family component to this. It's one family serving another family, and that's the way I've always looked at it. It really is. I know how hard our clients have worked for their wealth. I know how hard they've worked because I talk with each and every one of them for a long time, and I stay in touch with our clients as well. That's one thing that is big for me, is we'll meet as frequently as you would like, and in addition, we also do our client conference calls once per quarter minimum, and those people love those. Oh my goodness! And the reason I'm big on staying in touch is because, again, from one family to another, we have your back here at DeGreen Private Wealth, and I don't have some big, fancy slogan or anything like that, but I have my clients' back. And I will have your back as well when it comes, when you dial 480-771-7000. We will have your family's back as well. So God forbid, look, should something happen to you, you will know that your spouse is taken care of. That they'll have somebody that they can turn to and say, okay, well, I'm dead, so, I want to know my spouse is taken care of. And that is something we unfortunately deal with. But making sure, folks, that you have a trusted advisor, someone you do trust, somebody who is watching markets daily, and who is a fiduciary, not just when it is convenient, or not just a fiduciary for their employer, i.e. they're doing what is in the best interest of their employer, but doing what is in your best interest. Fiduciary used to mean something. Sadly, it doesn't. But fiduciary means something here, and that is we are always going to do right by you and your family. Period. Because that is what it is about. You have worked hard for that money. You have done all of the right things. You have. You've done it. And so now is the point where you got to walk it across the finish line, where you need to be prepared for retirement. Because again, retirement is not a balance sheet. It's not a group of numbers. It's not even a portfolio. It is the next great chapter of your life. That's it. We can wax poetic about financial philosophies and so on, but ultimately it comes down to this. Do you have a cash reserve? Yes? Good. That's a very important thing. Is your portfolio, is the level of volatility and the level of, and frankly, the amount of risk in your portfolio, does it suit your longer-term investment goals and objectives? Yes or no? And do you frequently discuss changes in your personal circumstances with your advisor? Does your advisor reach out? Does your advisor reach out ever? Now, throughout the year, one of the things we're doing is calling clients and saying, hey, we love you. We're just calling our best looking clients, and we thought of you, and how's everything going? Things like that. Again, that personal aspect to it, because again, this is a long-term investment program. And as such, our program, our philosophy, our style, everything is tailored to help you succeed in the long term. And that means doing the right things today, the right way, the first time. The right thing, the right way, the first time. So, while you have worked hard for that money, you don't need an annuity. While you want protection, that's not the way to get it. A disciplined investment approach, a prudent withdrawal strategy, which is something we will discuss, in addition to when to take Social Security and a million other things, folks. We won't discuss all of it over the radio because there's quite a bit to discuss. But I've got time, and I'm here to help. So I sincerely hope, folks, that you take action and give DeGreen Private Wealth a call, because we look forward to hearing from you. That's one of my favorite parts of this, is hearing from people. And I know many of you have called during these 2 hours. And look, I usually stay about 20 or 30 minutes after the show to help answer phone calls. So it is not too late. And I would encourage you to give us a call. 480-771-7000. That's 480-771-7000. And in addition to that, for those of you who are out doing things, you say, I can't do it right now, but I want to, I know I need to, and you know what? I might even give it to my husband as a Father's Day gift. Well, 480-771-7000, you can dial it and hang up. That way, at least you have the number so that you are ready to take decisive action. I understand. It's, there's a lot that you're probably thinking about. Oh, should I, is this going to be a lot of work? What are the tax implications? All of that, folks. We've been doing this long. We're getting pretty good at it, where we will discuss those things and how to address all of that. All of that. Whatever concerns you have, whatever needs you have, we're here to help address those. And as problems arise in retirement or situations arise, we are right here with you to fight for you and to make sure that everything that can be done is being done in pursuit of your longer term investment goals and objectives. So I want to encourage you to give us a call, 480-771-7000. Give DeGreen Private Wealth a call, 480-771-7000, or dial and hang up. That way at least you have the number, 480-771-7000. You can also visit us on our website, DeGreenPrivateWealth.com. That's DEGREEN privatewealth.com. And on that beautiful website is our most recent past shows and our contact form where you can reach out to us as well. But by far, folks, the best way to get started, 480-771-7000, 480-771-7000. We'll see what happens this week with everything. But ultimately, folks, give us a call. Visit us on our website. Let's get started. I am investment advisor Sam DeGreen on News Talk 550 KFYI.
This hour was proudly sponsored by DeGreen Private Wealth in Scottsdale.